My name is Michael Sabo. I'm a senior market strategist with RJOF Futures here in Chicago, bringing you a webinar on the basics of understanding options. Futures and options on futures carry significant risk and may not be suitable for all investors. So what exactly is an option? Well, options are contractual agreements that provide the right but not the obligation to buy or sell an underlying asset at a certain date at a certain price. The premium that the buyer pays is the price paid for that right. In futures, the underlying asset is a futures contract in the same expiration month as the option. So why do people trade options? Well, a few reasons that traders choose to trade options on futures are defined risk. Unlike futures trading, in which the majority of cases have unlimited risk, when you purchase an option, you can define the amount of risk you have. So that's a big reason why traders like to buy options, because they know their risk is limited to the amount that they paid for the option, which is the premium, plus their transaction costs. Another reason is leverage. Just like futures, your money works hard for you in options trading because of the leverage involved. The premium paid when you buy an option is only a small percentage of the value of the underlying futures contract, and it varies based on several factors, including the time to option expiration, the volatility in the market, and the underlying price. And another reason would be to generate income. Selling options, for example, selling a call option against a long futures position, a strategy known as a covered call, provides additional income because you collect the premium that's paid. So remember, in just like in futures trading, for every buyer there has to be a seller. It's the same thing with options trading. So if you're purchasing an option, someone else is on the other side selling you that option. When you buy the option, you pay the seller the premium. If you're selling the option, the buyer pays you the premium. So when you do a covered call, if the market is flat to lower, you'll be able to keep both your futures position and the option premium. If the market rallies, you may have to deliver your long futures position to the option buyer at the strike price, also known as being called away from you. And then your profit would be limited to the premium you collected on the option, and then the difference between where you entered the futures contract and the strike price. So what are options on futures? So there's two different types. There's calls and there's puts. A call gives the buyer the right but not the obligation to buy, also known as go long, a futures contract at a certain price, which would be the strike price, prior to option expiration. So if you think prices are going to rise, you would buy a call option. Conversely, puts, these give the buyer the right but not the obligation to sell or go short the underlying futures market at a certain price prior to option expiration. So if you think that prices are going to fall, you would consider buying a put option. So let's take a look and talk a little bit here about buying versus selling options on futures. So a lot of individual traders will tend to buy options because they know what their maximum risk is up front. And we kind of discussed that earlier. So as the buyer of that option, you're going to pay a premium, and that's what your risk is going to be limited to, the premium that you pay for that option plus your transaction costs. Selling options can give you opportunities to profit because you collect and keep the premium the buyer pays if the option expires worthless or if the option decreases in value. So in other words, if you sell an option, let's say for example in the crude oil market, and you sell a call option for $2, which in the case of crude oil would be $2,000. If the value of that option for whatever reason declines and it becomes worth, let's say, $1,500, and then you choose to buy that option back for $1,500, you would make the difference between the sell price of $2,000, the buy price of $1,500, thereby you would keep the $500. So the only thing is, when you sell options, there is potentially unlimited risk when you're selling a naked option. Now, you can define your risk when selling options if you use an option strategy such as a credit spread to protect yourself. So for example, a credit spread would be, let's say again in the case of crude oil, let's say crude prices are trading at $58 a barrel, and you sell the $62 call for $2, and then you buy the $64 call for $1. So now what you've done is you've calculated your risk. Your maximum risk in that example would be the difference between the strike price you sold and the strike price you bought. So 62 to 64, that's $2, and the maximum profit potential that you could make in this example would be $1. The difference between what you sold the $62 call for and what you purchased the $64 call for. So you could potentially make $1 in this example. That would be known as a credit spread. So let's talk about here a couple of tips on looking at options here. Well, first of all, one thing that I would strongly recommend to traders is that you should understand the leverage and the specifications of the option. So know about what the underlying contract is. Know your option expiration dates. Know a little bit more about the actual market before you get involved with it. If you're selling options, you should certainly understand the margin requirement, what's associated with selling it, and certainly the risk associated with selling that particular option. And then, of course, understanding break-even points. So basically, know the mechanics of where the money is made at and where the money is lost at based on market action. Let's talk a little bit about options terminology, some things that you should certainly want to become familiar with. And these are just a few of them here that we'll touch on in this particular webinar. One would be the strike price. And the strike price is the price at which the underlying futures contract can be exercised. Sometimes it's also known as the exercise price. So when we talked about the crude oil example earlier, and we talked about a $62 call option, the $62 is what would represent the strike price. That's important to know, because when you talk about trading options, or you're contemplating trading options, depending on the strategy that you're using, you're going to want to make sure that when you look at the strike prices that are available to trade, that there's a position there that coincides with what you think is going to happen in the market. So in other words, if you think crude prices are going to go up to, let's say, $70 a barrel, and they're currently trading at $58 a barrel, and you contemplate buying a $62 call option, and crude does go to $70, well, that might be a viable strategy, because your option has the potential, you believe, to go at least $8 in the money. So that could be a viable strategy. Time value. Now, time value is the portion of the option premium based on the amount of time remaining until the option contract expires. So again, in the example we talked about in crude oil, if crude's trading at $58 a barrel, and let's say the July $62 crude call is trading at $2, well, if the futures is at 58 and the strike price is 62, and that option's worth $2 right now, the $2 represents all time value, because the futures is trading below the strike price. Volatility. That's the amount of price movement in the underlying market over a certain period of time. So generally what you can expect is the more volatile a market, the day-to-day price action really making large swings, options, both calls and puts, can typically be more expensive because there's a lot of volatility, a lot of price movement. Conversely, if there's very little volatility, the market is basically flat and has been flat for a little while, volatility will get pulled out of those options, simply because the market's just not trading. The ranges on the market aren't that big. The market is kind of flat, so there's nothing, so to speak, to be excited about in these options. So if you anticipate that you could see an increase in volatility for one reason or another, and the market has been flat, purchasing an option could be a good way to potentially take advantage of that. Intrinsic value. That's the difference between the underlying futures contract price and the option strike price. So in intrinsic value, in order to have intrinsic value in an option, and we'll use the crude oil again as an example, the strike price must be in the money. So in other words, if that $62 call option, the futures would have to be trading above $62 in order for there to be intrinsic value in it. So if crude, let's say, was trading at $63 a barrel, and let's say that option was worth, the $62 July call was worth $3, the market's at $63 a barrel, there would be $1 of intrinsic value in there, because the difference from 62 to 63 is $1. The other $2 in the premium would be comprised of time value, because there's time remaining left in that option. So the option might be worth $3, $1 of it intrinsic value, $2 of it time value, for a total of $3. So if the option is out of the money, then all that option value would be comprised of would be time value, which is what we spoke of earlier. And one thing I want to mention to you is that many of the things that we've just covered here in this basic options webinar can be found in our Intro to Options on Futures guide. That's available on our website or by contacting one of the RJO futures brokers. They'll be more than happy to help you out with that guide. In addition, we also have an excellent option strategy guide, and I only touched on a couple of basic strategies in this particular webinar, as this is more of a basic overview of what options are. But for those of you that are interested in learning about a little bit more complex strategies and how you can apply options trading strategies to the market here, the Option Strategy Guide is a great resource. Gives many examples of different strategies to use based on what you believe it might happen in the marketplace. Again, my name is Michael Sabo. I'm one of the senior market strategists here at RJO Futures. And one other thing I'd like to mention here is our RJO Futures eView newsletter. I do write the column in there on the oil market, and I'd suggest, if you're interested in getting some great information on the more actively traded commodities, to go ahead and sign up for that bi-monthly newsletter. It is free and available, and it can be a great resource for traders. So I want to thank you for tuning in to this particular webinar. Stay tuned. We'll have some other webinars coming out here to help you get a better understanding on the futures and options markets.